Hello everyone, it's Elliot Gu here with the Free Market Speculator and the Energy Bulletin, and I want to welcome you to my Sunday Deep Dive. In this weekly video, we take a look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or at least what I think it means, for financial markets. You've probably heard the claim that a weak dollar is bullish for oil prices. Psychologists might call it the illusory truth effect. Simply put, that means that the more often a concept is repeated, the more likely the human brain is to accept it as fact, regardless of whether it's true or not. It also helps that it seems logical. The idea is that oil is priced in US dollars, and it is a real asset. So when the dollar is weak against other major currencies around the world, that means you need more dollars to buy the same barrel of crude oil. It's basically a monetary purchasing power effect. Well, rather than just accept this link between a weak dollar and stronger oil prices as truth, how about we actually look at the data? To create this chart, I examined data on the US dollar index, commonly known as Dixie, and front month WTI futures prices since April 4th, 1983. The Energy Information Administration, or EIA, they only publish data on oil futures and spot prices since the early 80s. Prior to that, a market price for oil is a little tougher to discern on a daily or weekly basis because a lot of oil was actually priced via contracting between international oil companies and oil-producing nations. The Energy Institute does publish an annual benchmark price for oil back to the 1860s, so much further back. And we've looked at it before. However, that's not particularly useful in this case for establishing shifts in the dollar-oil relationship and correlation over time, as the data just isn't high frequency enough. I'll have more to say about a proxy correlation I've produced that allows us to look back into the early 1970s, and I'll talk about that here in just a few minutes. Now, rather than calculating a correlation between oil and the dollar index for the entire sample since the early 1980s, I took weekly log returns for oil and the dollar index since the early 80s, and then I calculated rolling 104-week and 156-week. That is 2- and 3-year correlations between changes in the value of the dollar index and WTI crude oil. Correlations range between -1 and +1, or -100% and +100% if you prefer to look at it that way. Where the former, the -1, represents a perfect negative correlation. The two assets move in exactly the opposite directions, while the latter, +1 or +100%, that indicates perfect positive correlation. So if a weak dollar going down, is bullish crude, we should expect a strong negative correlation. The dollar and crude move in opposite directions. To make the positive and negative correlations easier to see, I've added a thick red line on this chart at 0. So when the rolling correlations are above that line, we're looking at positive correlations, and below the red line, negative correlations. Now, 3 points to note on this chart. First, on both a 2- and 3-year rolling look-back window, correlations between the dollar and oil spend a lot of time hovering right around 0, a weak positive or negative correlation. Secondly, there is a long period from roughly the early 2000s up until 2014-2015 when oil and the US dollar were negatively correlated. Depending on the time frame you're watching, that negative correlation peaked in the -40% to -60% range back in the 2009 to 2013 era. Third, and most important, the rolling 2-year and 3-year weekly correlations are now the most strongly positively correlated that they've ever been, going back to at least the early 1980s when this chart starts. To be clear, this is the exact opposite of the widely repeated rule of thumb regarding the relationship between a weak dollar and strong crude oil prices. In the past few years, a strong dollar has tended to be bullish for oil prices, and the dollar and oil have tended to move together, not in opposite directions, as the traditional dollar crude oil monetary framework would predict. Now, as I said, we don't have reliable weekly data on WTI back through the 70s, though we do have data on the US dollar index, DXY, back to January 1971. And as most viewers are aware, the 1970s represent the most famous, at least relatively modern example of a commodity supercycle. It's also the decade most closely associated with the term stagflation, which, according to 69% of those surveyed in the most recent Bank of America Global Fund Managers Survey, they believe stagflation represents the base case for the global economy over the coming year. Since we're only looking at rolling correlations since the early to mid 80s, we're missing the classic commodity and inflation weak dollar decade prior to that, the 70s. So I decided to create a proxy for the performance of energy based on data for shares of ExxonMobil, today the symbol is XOM, and Chevron, symbol CVX, because we actually have closing price data for both names and their precursors back to the early 1960s. I'm going to keep this part of the video on the short side because it's a little bit esoteric, especially for Sunday afternoon. Sorry in advance. However, I do think it's important to understand exactly what my proxy is before I show you the chart, so it's not just a black box coupled with the words, trust me. As any investor, even just casually familiar with energy markets will tell you, right? Oil prices and energy stocks are two very different animals. For one thing, the former is a commodity. It's driven by shorter-term supply and demand conditions, while Chevron and Exxon are fundamentally stocks at the end of the day, and they will therefore have considerable leverage to broader sentiment surrounding US stocks, equities, and the performance of the S&P 500 index in particular. Comparing the raw returns for Exxon and Chevron to oil, that's going to skew the picture. In nasty bear markets like 1973-75 or 2007 to 2009, energy stocks will tend to get dragged down by the falling tide of a weak S&P 500, regardless of their underlying fundamentals and leverage to oil prices. To get around this a bit, I calculated an equal weighted index of just those two stocks, Exxon and Chevron, and I beta adjusted this index to the S&P 500 using a trailing 1-year beta calculation. Now this helps account for the fact that Exxon and Chevron have, at times over this period, moved faster than the broader equity market, had a beta higher than 1, and at other times they've moved slower, having a beta far less than 1, and it really just depends on the exact time frame you wish to examine. So then I took this index and I took the alpha of this index. Now what the alpha is, that's actually performance of my index of Exxon and Chevron relative to the S&P 500, rather than on an absolute basis. Now the idea here is to give us a rough idea of correlations between the dollar and energy markets dating back to early 1973, actually late 1972, which was the dawn of one of the most famous energy crisis periods in American history and global history. This chart is noisier than the chart showing the correlations between the dollar and WTI since the early 1980s. Likely a function of the inherent volatility of equity markets and the near constant rotation in stock market leadership between sectors over time. However, what's remarkable is that we see two patterns in this chart since the early 1980s that mirror our chart of the WTI dollar correlations. First, there's a period from roughly the early 2000s and around 2014 where energy proxy was negatively correlated to the dollar. A weak dollar was bullish for energy stock outperformance, right? And vice versa. And second, right now, the energy proxy and the dollar are showing record-setting positive correlation. So energy stock outperformance tends to move when the dollar is strong, not weak. Tends to be stronger when the dollar is strong, not weak. Just as with the dollar WTI relationship, the current positive correlation of the dollar and my energy proxy goes against that conventional wisdom of the investing crowd that a weak dollar benefits oil prices and energy. What's also interesting is that we can see that that early 1970s period on this chart now, which we couldn't on the other chart of WTI and the dollar. And there is a clear negative correlation between the US dollar and our energy proxy in the commodity supercycle, energy crisis, and stagflation years of particularly the mid to late 1970s. So at this point, you might be wondering why a weak dollar and rising oil prices went hand in hand in the commodity supercycles of the 70s and early 2000s, while today, amid a significant bull market in oil and energy stocks going back to 2020, this entire relationship has been flipped on its head. I'll jump into my view on exactly that point here in just a minute, but first let's examine the relationship between the US dollar and gold over the same time frame. Simply put, I want to examine whether this is a phenomenon that's unique to oil and energy, or if we're seeing this contrarian positive dollar commodity correlation in other markets as well. Now this chart is actually pretty definitive. We are not seeing positive correlation between the dollar and gold. Quite the opposite. There's really only a very brief period back in the early and mid 1990s when the US dollar index and gold were positively correlated on a rolling 2-year and 3-year basis. Unlike the WTI dollar chart, the correlations between gold and the dollar are rarely close to zero. And we've seen dips close to negative 70% correlations, particularly during the commodity supercycle periods of the 1970s and the 2000s. Today, the negative correlations aren't quite as strong as they were a couple of years ago, but we're still hovering in that negative 30 to negative 40% range, compared to the WTI dollar correlations at positive plus 30 to 40% right now. So I'd say gold is acting as the conventional wisdom might suppose. A weak dollar is bullish gold, but not West Texas Intermediate crude oil. How about silver? Well, silver correlations generally track gold, as you can see on this chart, certainly more closely than they track oil. Not quite as negatively correlated to the US dollar as gold, but silver does generally benefit from a weak dollar, and the 2- and 3-year rolling correlations right now are in that negative 20 to negative 30% range, significant negative correlation. Weak dollar, positive for silver, generally. So this switch in the correlation sign is evident in the oil market, but not in the gold or silver markets. The reason? It's all about shale, and the fact that the US has a huge advantage in energy relative to most other major economies in the world, including Europe and the United Kingdom, the main components of the US dollar index, as well as China, the world's second largest economy. Take a look. This chart shows the US dollar index rolling correlation to oil as a dark blue line, and the scale for that is on the right-hand side of this chart. The orange line shows the monthly data from the US Energy Information Administration, the EIA, which shows US net imports of crude oil and petroleum products. Now that is a broad definition that includes crude oil, what most people are probably thinking about right now, as well as arguably even more important exports of refined petroleum products like gasoline, diesel, and jet fuel. Also natural gas liquid, NGLs, like propane, ethane, and butane. Also petrochemical feedstocks, and blending components like exports of diluent to Canada, which enables oil sands production. This does not include liquefied natural gas, LNG, or pipeline exports of natural gas to Mexico. The EIA reports this data as net imports, which means that a positive number indicates imports, while a negative number would be net exports. To account for that, I inverted the left-hand scale. This data is since 2003. So we can get a close-up look at the big flip. What you can see is fascinating. US peak import dependence was August 2006, when the nation imported 13.442 million barrels per day of oil and petroleum products. That was, of course, before the shale boom, which for oil anyway, really kind of took off starting in roughly 2010. The most recent data we have is for March 2026, March of this year, when the US was a net exporter of a little over 3.7 million barrels of oil and petroleum products per day. So the swing here is 17.16 million barrels per day from that month of maximum oil imports about 20 years ago in August 2006 through to that 3.7 plus million barrel per day of exports we saw in March of this year. So let me put that number into perspective. Saudi Arabia's total production capacity is thought to be over 12 million barrels of oil per day, but a lot of that crude is actually used domestically. So typically, exports fall in the 6 to 8 million barrel per day range, and Saudi rarely produces at their maximum capacity or anything close to it. So that 17 plus million barrel per day swing in US oil trade from a massive net importer to a significant exporter is more than 2 Saudi Arabias, if you will. That's a lot of oil. A couple of additional dates to note on this chart. First, October 2019. That's the first month following the shale boom that the US became a net exporter of petroleum products and oil. This was before the coronavirus lockdown recession of 2020, long before anybody had heard of COVID-19. And while the immediate post-COVID trend was volatile, the US has generally seen a steady uptrend in oil and petroleum product exports since late 2021, early 2022. Also not labeled on this chart, not labeled this time, is December 2015. Now that's when President Obama at the time signed the Consolidated Appropriations Act of 2015 into law. This was a budget deal and a compromise that included a measure to lift a ban on oil exports that had been in place since 1975. Lifting the oil export ban was a priority of the Republican-controlled Congress at the time that they pushed to be part of this deal. What's really interesting here is that the correlation between the US dollar index and oil prices was most negative when the US was a huge net importer of oil and petroleum products back in that 2006 to 2010 period. Remember, this correlation is a 2-year rolling number. So there's going to be something of a delay a lag between a major change in the US dollar-oil relationship and the rolling correlations turning higher or lower. The dollar has gradually grown less negatively correlated to oil. The traditional relationship started to break down just as the shale revolution took off in the 2010s, and net imports had halved to 4 to 6 million barrels per day by 2014-2015. The 2-year rolling correlation between oil and the dollar then flipped positive shortly after the US became a reliable net exporter of oil and petroleum products as we move into the current decade of the 20s, by which I mean the 2020s in this case. Bottom line, the flip in the dollar-oil relationship, it's structural, not cyclical. It has nothing to do with the Federal Reserve, monetary policy, or the US dollar status, or lack thereof, as a reserve currency. If that were the case, then we should see a similar flip in markets like gold and silver. Now, American financier J.P. Morgan once said that gold is money. Everything else is just credit. He said that back in 1912, and it's been true for millennia. Today, global gold mine supply adds maybe roughly 1 to 2% to above ground supply stocks annually. Gold is essentially indestructible, and almost all of it ever mined still exists today. Industrial demand like electronics and dentistry, they're bit players when it comes to global gold demand. Most demand for the Midas metal, it's jewelry and investment, ETFs, central bank demand. These are all essentially monetary in character. Gold doesn't get consumed, it gets held. That means its price is almost entirely determined by the opportunity cost of holding it, real interest rates, and by confidence in fiat currency systems. The Fed is not secondary for gold, it is the primary driver right now. Accordingly, the traditional US dollar-gold relationship hasn't flipped. It's still deeply negative, but it has flipped for oil. Oil is not like gold. It's primarily a consumption commodity. It gets burned. It has overwhelming industrial and transportation demand components, and its price is ultimately anchored by the marginal cost of production and the balance of physical supply and demand. That's why the shale revolution has flipped the script for WTI and the dollar index relationship. It's also worth remembering what the dollar index is. The dollar index measures the value of the US dollar against other currencies around the world. The euro has a commanding 57.6% weighting in the dollar index. Japanese yen at number 2, 13.6%, and the British pound at 11.9%. Then the Canadian dollar at 9.1%. No other currency in the world accounts for even 5% of the index, except for those I just mentioned. It's the dollar measured against part that needs additional emphasis. It's not just that the US earns more from energy exports when prices are high, since it's a net exporter now. It's that high energy prices disadvantage almost every competitor simultaneously. Europe, which dominates the US dollar index, is a huge net importer of energy commodities. And the region's ongoing energy crisis, well, it highlights the fragility of the Eurozone. The UK is also a growing importer with the North Sea in decline, and Japan is almost entirely import dependent and always has been. Consider this. This chart breaks down US primary energy supply by source from 1965 to 2024. It's based on the data from the Energy Institute's Statistical Review of World Energy, which is a treasure trove of long-term energy market data that was previously published by Britain's BP. Primary energy supply represents energy used for all purposes, whether it's gasoline in a car, diesel powering a freight train, or natural gas and coal used to produce electricity. Look at the areas I've boxed in my chart, representing the period from 1965 to 1980, the left-hand side of the chart. As you can see, oil was both a dominant and growing source of US energy supply from the mid-60s until the late 70s. At the peak in 1978, oil accounted for 50.3% of total US energy supply, with natural gas at 25.3% and coal at 18.4%. Think about that. In the late 70s, oil was more important to the US energy mix than the next two most important fuels combined. Today, the US mix is very different, as you can also see on this chart. Oil is still the leader at 39% of US energy supply. However, natural gas is almost as important at 35.4%, followed by nuclear at 9.8%, coal at 8.6%, and non-hydro renewables at a distant 4.3%. Now let's examine the countries in the region now represented by the European Union. I'm presenting this data on the same basis, and I've boxed the same period from 1965 to 1980. It's striking how similar the energy systems of the US and Europe looked back in the 1965 to late 1970s period. In both regions, oil was the top source of energy and of growing importance through the 1970s. At the peak in 1973, oil accounted for 55.6% of EU energy supply. Today, and some may find this to be a big surprise actually, the US actually derives more of its total energy supply from oil at 42% than the US at 39%. The same is actually true of coal, with Europe at about 9.1% versus the US at 8.6%. Here's my point. In the 70s, the US was in a very vulnerable position from an energy perspective. US oil production was declining, demand was growing, and the nation was increasingly dependent on rising imports from the Middle East to close the gap between supply and demand. The surge in oil prices amid the OPEC oil embargo of the early 70s was an undeniable negative for the US economy, simultaneously acting as a tax on consumers, driving up costs for manufacturers, and acting as a turbocharger for inflation. Accordingly, the 1973 to 1975 recession in the US was the worst since the Great Depression. Based on economic statistics alone, it's arguable that it was as bad or worse than the great financial crisis of 2007 to 2009. Certainly, it's the only other post-war cycle that can challenge the Great Recession period in severity. Europe was in a similar boat. On the negative side, Europe had even less domestic energy production than the US, making it even more vulnerable to import supply shocks. On the positive side, Europe was actually more reliant on coal than the US back then, and European coal supply was far less reliant on imports than oil. So an undeniable negative for Europe's economy and manufacturing system in the 70s, energy crisis years, just like the US. Today the story is very different. Yes, oil prices are set globally. So a conflict-driven spike in international oil prices like we're seeing today, it does flow through into the US market. And that ultimately acts as a tax on the consumer. However, the US economy in aggregate also benefits from higher oil and refined products prices these days, since it's the world's largest oil producer and a sizable exporter of oil and refined products, as we just outlined. Meanwhile, given LNG export capacity constraints, US natural gas prices have decoupled from the rest of the world. The US is the world's largest producer of gas, and that's helped keep domestic electricity prices, as well as manufacturing costs in energy-intensive industries, far, far lower than the rest of the world, 2 to 3 times lower than Europe. And since key technologies such as artificial intelligence are by definition energy-intensive industries, plentiful, low-cost natural gas is also a key and underappreciated tailwind for technology's growth, specifically here in the US. On a relative basis, America's comparative advantages in energy are stark relative to Europe and the United Kingdom. Once again, don't forget, the Europe and the British pound are the first and third most important currencies in the US dollar index. Simply put, it's not difficult to see why the relationship between oil and energy prices and the US dollar might have shifted since the 70s or even the early 2000s. It's due to the fact that the very structure of the economy has shifted, and the US dollar is, in many ways, a natural resource currency in a way that would have been unimaginable 50 years ago in the 70s. And that's the final point I want to touch on today. For many years, we talked about currencies like particularly the Canadian dollar and the Australian dollar as natural resource currencies, or petrocurrencies, you'll sometimes hear. They would benefit from higher energy prices, or in the case of Australia, higher iron ore prices. Well, let's look at a rolling 2-year correlation of the Canadian dollar to WTI oil prices. This chart shows the period from 2005 to the present. And for most of the period covered by my chart, the Canadian dollar's value against the US dollar has been positively correlated to oil prices. So that's basically the definition of a commodity levered currency or a petrocurrency, right? Canada's natural resource sector is huge relative to the economy as a whole, and it tends to benefit from higher oil and energy prices. However, look what's happened here. Since 2022 and 2023, the correlation has dropped to effectively 0, even negative. Now, before my Canadian viewers jump into the comments section or through the screen and go into attack mode, this doesn't mean that the Canadian dollar is now no longer a currency that benefits from the nation's abundant resource wealth. Rather, remember that we're looking at an equation here of the Canadian dollar divided by the US dollar, CAD over USD. So this tells us as much about the US dollar on the denominator as it does the Canadian dollar on the numerator. It's the relationship between the two. The near zero Canadian dollar correlation with WTI is itself evidence of the structural shift in the US dollar I just outlined. Theoretically, if US dollar has acquired positive oil sensitivity comparable to the Canadian dollar, the bilateral cross rate between the two currencies that both move with oil will naturally flatten towards 0. Not because the loonie has lost its energy character, but because the US dollar has gained one. I think this illustrates a key issue as well for investors. It's totally logical to use the 1970s and the 2000s commodity supercycles as an analog for the current environment. However, it's dangerous to assume that history will repeat itself exactly. It's more a rhyme than a repeat, due to structural changes in the global economy over the years. One of my favorite things about financial markets is that when I do a deep dive down the proverbial rabbit hole of a specific topic like this, in this case the US dollar oil relationship and the 1970s analog, I find some answers, hopefully anyway, right? But I also encounter a dozen new rabbits. Those form the basis of potential future deep dives and Sunday Deep Dive video topics. One point I find extraordinary is the fact that the United States today is simultaneously the world's largest economy and the world's largest oil and gas producer. It's very unusual in history for an economic and technology hegemon like the US to also be a leader in the production of key natural resource commodities. The closest analog might be Britain in the mid-19th century, when it was simultaneously the workshop of the world, the dominant naval power, and a major coal producer. Although coal was never globally traded the way oil is today, and sterling's commodity linkage was never as direct. The Bank of England does, however, publish some of the world's most impressive economic data sets via its millennium of macroeconomic data. Not to split hairs, it's actually 800 years of data, not 1,000, but that's still very, very impressive. So I'm actually thinking about I may dig into Victorian Britain at its height as an analog in a future video. At any rate, that's it for this week's Sunday Deep Dive. I hope you found it useful, and I'd appreciate it if you drop me a like, drop me a quick comment, or if you have not done so already, sign up to receive these weekly videos and much more. We do have a free tier to the service. And if you are interested in the paid tier to this service, including both the Free Market Speculator and the Energy Bulletin publications, and the model portfolios attached to both, I am offering 30-day free trials for a limited time via the link I'll leave down below. Thanks again for listening, and I hope you enjoy the rest of your Sunday.